This is John Shealy. This is the Traders Country Club video of the day, and we have to take a look at Goldman Sachs. Take a look at the daily range for Goldman Sachs. What an incredible range for the day. This is 800% times the average daily range that Goldman Sachs was moving on a daily basis. One of the reasons I wanted to cover Goldman Sachs is to make this main point. First, 2-3 times a year in almost every trend, regardless of stock or commodity, there is a news event that occurs suddenly that will drive prices against the current trend at the time of the news. This is a perfect example of out of nowhere, a news event occurs, and you can see the extent that it completely erased the bullish trend that Goldman Sachs was developing for the last part of March and early April. This came out of nowhere, and traders would have gotten blindsided because by all rights the trend was bullish and long positions were suggested. If you had a stop loss, you have gotten triggered. Now let's talk about where that might have occurred considering the news came out suddenly while prices were trading. Now we're taking a look at the 5-minute chart, and you can see when the news came out, the market had a tremendous decline, trading about above 180, 182, 183, depends on to what extent you were trading that particular market. News comes out, drops quickly to 170. So in regards to sell stops, they were probably filled in this particular time period. But notice the market was able to rally. A trader did have time to make a decision of whether or not, basis the news, he wanted to close out any long position. He had plenty of time to do that. So, and this is not like the occasion where there are, occurs in commodities from time to time and some stocks where the devastation of the news, most people are being stopped out at the lows of the day. You can see that's not what occurred here. The market tried to rally, and then you can see the market basically over the next 30 minutes did reach extreme lows for the day. Now what is interesting is that we closed higher than the lowest point. But considering the bar that you see in the daily prices, there were other traders who began to look at, they may have missed the Goldman Sachs bull market previously. They were looking for a drawback. Well, those who were looking for a drawback and believe that this news event is going to be short-lived, then for them this was a bargain price to come in and buy into the market. Let's take a look at the daily prices again. Here you can see that any trader who is interested in buying the stock, he's looking at prices now that weren't seen until a couple of months ago. Now, why can a market be worth a buy when there's such bad news? Well, that can occur if your analysis of the stock is that the bad news is pretty well baked into the price, that a stock can't be pummeled anymore because how bad can the news be? You want some proof of that? Take a look at the stock Toyota. The bad news was bad. Cars were accelerating, crashing, deaths occurred. Crash comes to Toyota Motors. But there's a point in time when that news is baked into the price. How bad can it get from that point of view? And you can see subsequently prices were able to rally because the perception began to exist that the bad news was in the price, and that therefore that stock was already reflecting the bad news, and any improvement in regards to the perception of the bad news would in turn create a perception of higher prices, and that's exactly what we've seen in Toyota Motors. Think of that as we talk about Goldman Sachs. If they continue to kill and hit Goldman Sachs much lower, there is a point in time where the bad news is going to be baked in that price, and that as you discover that a lawsuit is not going to be reaching trial for years, that's when Goldman Sachs may quickly return to its previous bullish trend, at least reversing some of this sell-off. This is John Shealy with the Traders Country Club.